All right, folks, welcome back to the Property Couch podcast. And have we got a great episode for you today? We're going to continue the conversation around the art of spending. And we're also going to talk about a very special launch coming up. What else are we going to chat about, Ben?
Bryce, we're going to talk about myth busting. So we'll finish off our series in myth busting by talking all things tax and financial planning. We'll myth bust all of those areas. And Bryson, what's making property news? I'm putting on my picker hat and I'm picking a little bit of a fight when it comes to tenancy reforms in Queensland. So I need your help. So stick around and learn more about that in the show.
Ben needs your help, folks. Stick around to the end of the show. We've got lots to cover. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast and welcome back to you too, mate. How are you?
Mate, I am well, and obviously what a good weekend.
Yeah.
Come on, surely you got to
Talking
get
about
back on
Mother's
the
Day,
wagon.
surely? Mother's
You got
Day?
to, well, of course, our beautiful mums around the world. We absolutely
you were going to go
love
straight
them.
to something else.
Yeah, I want to go straight to Freo, knocking over Sydney in Sydney. I mean, are you back on? Are you coming in?
Mate, I'm having a gap here. I'm having a gap here.
You are killing me in the tips, I've got to admit. I picked Hawthorn on the back of you telling me that they're no good, and I thought they'd cause an upset over in the West. Well, that didn't happen. Now you've gone two in a row by knocking off Sydney, which is a team I rate. So you're killing me.
This is proof, mate. A mate of mine in Sydney goes, Freo looking good, Swan's unbelievable. This is a text message. Why we put ourselves under so much unnecessary pressure is beyond me. Franklin brain snap doesn't help. And I've gone, haven't even looked in the direction of that game, mate. Your text sounds like Freo might be in front. He comes back, yep. He goes, looks like Freo is going to take this one. Swan slump continues to deepen. A long way must go. It's got to be a standard line when coaches have got to go. Got to sack the coach. So, all right, mate, indulge us. Where are you on the ladder? Are you third? Are you fourth? Are you seventh? Where are you?
The Pies?
Yes.
Oh, look, I don't think I need to say that. Let's move on. We'll move on.
I gave you a layup and you didn't take it.
Game clear on top.
Hey, very special thanks to Chad for last week. It was a great chat. We got some really awesome feedback around that. So a little bit ironic, Ben, that you and I bang on about AFL and yet we've had all these wonderful NRL folks who have supported the show. So we're doing a little shout out to anyone through 1 degree, 2 degree, 5 degrees, 6 degrees of separation. If you know anyone in the AFL community who loves property and would like to come and have a chat on the Property Couch, we would love for your help. That extends to AFLW. That extends to swimming, soccer, netball, anything where someone has a really cool story to share and they love property. We would love to talk to them because we think that would benefit. Because if you were listening to last week's episode, what I think came across really well is Chad had his feet on the ground. He could relate to the common person. Sure, I'm sure his income is not something that people can relate to when he's at his peak of his powers, but there's certain parts of his career where he wasn't at peak income. And what did he do about it and all the things that went ahead of that? So just if you could help us out, if you know anyone connected who has a great story to tell, let us know. Just reach out to Stiggy here, info@thepropertycouch.com.au. Let us know. And we would love to be connected as well, Ben, wouldn't we?
We'd love to. I mean, yes, I know of a few of the Collingwood boys are interested in property because I've had chats with them. But certainly anyone.
Sorry. Before you go ahead, anyone except for Collingwood. That is probably needed to be a bit clearer. Sorry. Yeah.
Oh well. No. Look, anyone. Here's the message we're trying to get through. We understand that some of these people get a lot of money over a very short period of time. But the best part about their stories is they're making hay while the sun shines. So what we learnt from Chad last week is he understood delayed gratification and basically putting money away for his future. What we're trying to teach here is people putting money away for their future. So you can be on really big income and have nothing really to show for it. And you may not be on that income for the rest of your life. And if you're enjoying that level of income, you need to build a passive income to supplement that for when you retire. Otherwise, you're going to be working for the rest of your life. So that's the big takeaway for me in any of these types of conversations that we have. And we go all spectrums, low income earners, right through to really high income earners, with the view that if we can get some of the key takeaways, and that is spend less than you earn, and then grab some of that money, around 20 or 30% of it, and build a tree, plant a tree and build it, and build a whole orchard of producing assets for you that will give you that same level of comfort for you and your family as you grow. So that's what we want to do. But of course, those people, they have interesting backstories, they have challenges. Chad came from a lower socioeconomic area. He had a parents who broke up. There's stories there that we can all relate to. And as he said, I'm just like the rest of everyone, except I get to play sport, and that's my job. And I love the work that I get to do. And so that's the message and takeaway for me.
If you only have to circle back to our MythBuster that we did 3 weeks ago, Ben, when we talked about great high income earners doesn't mean great money management.
Yeah,
high income earners can earn money that they don't have a profile where they're on the telly every Friday night or Saturday afternoon, but still having the same challenges. So again, thanks for sharing the message. Thanks for being humble and letting people see behind the veil of what it's like to be a professional athlete. So that was really good. And of course, if you can help us with our shout out for that, Ben, I've reached out to the great Matthew Pavlich, ghosted. I've reached out to the great Matthew Lloyd, ghosted. So if anyone knows any, and I know they're property people.
Two great Matthews. Chase for the two great Matthews.
Great Matthews. There you go. There's a good starting point. Hey, we got a start and build course, Ben, that you and I have put together that helps people. If you read our book, you can actually then go, well, okay, that's the what. I need to know a little bit about the how. So you and I put together a course called Start and Build. We launch that once a year. We take an intake of students, enrollments, and that is coming up very, very shortly. So just wanted to let people know that the theme for our Start and Build launch this year is around the fact that if you've just experienced some challenges through household pressures, interest rates, inflation, all those sorts of things that are putting pressure on households, the theme is we want to set you up so that when that cycle comes around again in the future, because what we know is this stuff, it's not the first rodeo for the inflation genie being out of the bottle. We want to set you up for the next cycle so that when this happens again in the future, you're not in a position where you need to worry about this. So that'll come. We're doing it at a heavily discounted price. And in a couple of weeks, we're going to open it up for about a week where people can enroll. And then once that enrollment period finishes, Ben, we won't be doing it again for the remainder of the year. So just letting people know. Now, I want to give away a course today, Ben, for free. And what we've done usually is we read out some reviews. Now, I've looked at all the reviews on our Property Couch site. So I want to challenge you, if you want to leave us a review and I read it out in the next couple of weeks, you give yourself a chance of getting a Start and Build course for free. But this one, Ben, caught my eye. It's positive, right? So you go, sure, it's positive. I've read out negative ones before, so just so you know. And if you need to give us a negative one, let us know. I'll read it out as well. But this one here is from Andy and friends. It's called University of Ben and Bryce. Now, just strap in, Ben. There's a bit here. But I like the thought that's gone behind it. Hi guys, a massive thanks and some information to some of the newcomers to your community. I wanted to give a genuine and heartfelt shout out in response to a review you had the other day. Like all good university degrees, I stumbled on the Property Couch a few minutes late, way back in mid to late 2015, after hearing Ben on another podcast dishing out the gold. Taking up a seat on my daily 30-minute commute, fresh in my new job after finishing uni, I was keen to learn more about property and life. These guys were a perfect match. The professors, Bryce, the charismatic, cool, young innovator. I like that he thinks I'm young, with his huge property networking power, paired with the sage financial wisdom and brains of the one and only Professor B. Kingsley. What do you reckon about that, Ben? That sounds like you. The weekly tutorials on the ABCDs built my foundational knowledge, and the guest lectures from property heavyweights, Jan Summers, Paul Clitheroe, Peter Koulizos, further developed my knowledge. The textbooks you printed added as take-home study guides, and the online tools the TPC developed evolved to further advance teaching in my finance management systems over the journey. I've also to say a massive thanks to Ben and Bryce for picking up the HEX bill. What? We picked up the HEX bill? If this was a uni course, I would have been up to about my 7th year with you guys. With a uni degree, I would be paying out $30,000 to $50,000 per annum plus CPI. These guys have me free knowledge. It's amazing. Not to mention access to special courses, presentations, insights, which probably cost me another $200 to $500 per seminar per month. To the newcomers to this community, these guys provide 100% free education on property and finance. They have access to insights and collaborate with Australian and global industry leaders. Sure, they talk a bit of footy banter. Is that true, Ben? Do we do that? And the 30-minute podcast is long gone. That is true. It is long gone. Fortunately, I now have a longer commute to the country once a week to fit in the 90 minutes of gold. I simply do not know where else you could find this genuine and evidence-based knowledge pulled into one place. I'm so thankful for what they deliver. Bryce is always enthusiastic and brings a positive energy each and every week. And Ben always shares a piece of gold. He is a miser, a mazer, M-A-S-E.
Master teacher, maybe.
What is it?
Master.
Well, mate, probably missed the obvious. Mr. T. He's the master and teaches me something each and every week. I've told all my friends, all of whom are thankful to have grown their knowledge on their property journeys with these guys as well. Hey, Andy and friends, thank you for that positive feedback. But what I liked, Ben, was the HEX debt. I like that bit that we are able to save money. That's some genuine value. Reach out to us, Andy and friends. Thank you for that review. We will give you a copy of Start and Build for free. And folks, just want to remind you, if you want to leave us a review, get creative, let us know what you're thinking. Even if it's negative, that's cool. If we read it out on the podcast in the next couple of weeks, we will also give you a copy of the Start and Build course in the lead up to the launch, about which we are going to embark on. So there you go, Ben.
Very humbling. Thank you, Andy, for those lovely comments. And it's why we do what we do. We just love paying it forward, love enjoying the value that hopefully people are taking away from the pod.
Well done. Hey, my Mindset Minute today, Ben, is a continuation of the Art of Spending Anecdotes podcast that I was listening to from Morgan Housel. I spoke about it last week. Number one, your family background and past experiences influence your spending preferences. If you haven't heard that, circle back to that because I think it's really, really important. But we're talking about the science and the art. The science is around budgeting and finding a bargain, but what is the art of spending? And self-interest here, Ben, I really wanted to dive into these concepts. I wanted to use this platform as an opportunity for you and I to riff it, also to share it with our community. I want to say it again. These are Morgan Housel's ideas, his thoughts. If you haven't read his book, go and read it. If you haven't listened to his podcast, go and listen to it. He's got a new book coming up. Just want to be clear that I am not trying to pick his pocket. These are just really, really good concepts. Ben's showing us there on screen for those watching on YouTube. For the rest of you listening on audio, he just put a book up on the screen that you will never see. But the second one is Entrapped by Spending. So rather than using money to build a life, your life is built around money. What does that mean? I told this wonderful story, Ben, about George Vanderbilt, one of the Vanderbilt heirs, billionaires back in a time when billionaires was like an extraordinary amount of money. There wasn't a lot of them around. And he built this house. It's called the Biltmore House. Took 6 years to build, 40 master bedrooms, full-time staff of almost 400 people. But he spent very little time in the house, Ben. You can actually, I went and had a look at this house. If you want to check it out, Biltmore, Biltmore House. Just think regal house, Ben, on these beautifully kept grounds on a massive size plot that looks across the valley. It's pretty sure it was in North Carolina. So it was enormous, right? And this is a quote. This is a quote from George Vanderbilt. This house is utterly unaddressed to any possible arrangement of life. It's basically a commercial building, so it didn't feel like a home, right? So here's the interesting part about it. It is amazing. It is ornate. It is ostentatious. It is regal. It is large. It is amazing. For most of us looking out, we go, wow, that's cool. But this house cost so much to maintain, it nearly ruined George Vanderbilt. 95% of the land was sold off to pay taxes. And then the house is now turned into a tourist attraction. So one of the largest houses ever, and he is a prisoner to it because it costs so much money to maintain. Think about that. Then in 1875, there was an op-ed in the paper, and someone made this comment, Ben. Someone was quoted saying that New York socialites devote themselves to pleasure regardless of expense. But no, George Vanderbilt actually responded by saying, no, actually, socialites devote themselves to expense regardless of pleasure. So here's the perception and here's the actual. Expense regardless of pleasure. When people go, no, it's pleasure regardless of expense. He said no. So the Vanderbilts were an extreme example of this, the devotion to expense regardless of pleasure, right? But it is a common trait amongst ordinary people. So part of this belief is that spending money will make you happier, when by and large it doesn't, either because of either because it never will, or you haven't discovered the purchases that will actually bring you the joy, right? So your reaction is, well, I must not be spending enough, so I need to double down again and again and just keep spending money, thinking that eventually it's going to make you happy. So interesting stuff, right? So it led him to wonder this. This is Morgan Housel. How many personal bankruptcies or just financial troubles are caused by spending that brought you no joy to begin with? Let that land. How many personal bankruptcies or just financial troubles are caused by spending that brought you no joy to begin with? You incur a double loss. You get the financial trouble and you had no fun getting there. So some are driven by the belief that money is to be spent regardless of what pleasure it may bring, but they are held captive by its influence and prisoners to their own money. So interesting, Ben, when you think about that, if we go back to what the anecdote is, entrapped by spending. Is anyone listening to this entrapped by spending? Are you actually spending money that doesn't bring you any joy? You're trapped by the expense, irrespective of that pleasure. Now, I'm going to lean into this on our life hack, Ben. So stick around for this because I've got more on it. But we also have this little chase that we are going to introduce, Ben, the chase for Morgan Housel. We're just going to just give a little snippet that we would love to get Morgan Housel on this podcast, and we're going to crowdsource this community who want to be a part of that journey with us. So stick around, folks, as I read this out over the upcoming weeks as we go through more anecdotes around the art of spending. We're going to enlist your help in the chase for Morgan Housel on this podcast, because I think that would be a wonderful coup, and I think we get a lot out of it. So, Ben, what do you think about being entrapped by spending? Seen it?
Well, yeah, you see it all the time, right? And you don't have to have a 40 master bedroom mansion, which I just was checking out whilst you were chatting about it. It's spectacular, right? But the point here is consumption spending, consumer spending on disposable items. I've got a young, influential child at the moment who keeps telling me about all the different types of basketball shoes that he wants for Christmas and his birthday, and so he's very much fell into that consumer mindset of wanting the best, having the best, and that's obviously always challenging, because if you build those types of attitudes up over time, you're going to eventually have no delayed gratification muscle memory. You're going to ultimately just trying to keep satisfying your needs by having the latest gadget or the latest in thing and feeling special in your own mind, when deep down inside, that's not where happiness lives. Happiness lives through experiences, through providing for others. So to Andy's point that he just mentioned before, like that the work that we do on this pod, for the time that we put into this pod, just for one review like that, Bryce, it's worth it. Just for one person to say that we've helped, and that's priceless for us in terms of how much value. And I get so much joy in that, as opposed to having the latest and greatest thing, which eventually is just going to be put in the garage or put somewhere else, and I'm not going to get much joy out of it. So I think from that point of view, if you can align everything with experiences and great memories, you're going to have a richer life, is the simple message there. And I think that spells it out nicely.
Interesting you say that about your son, Ben. I don't think YouTube helps much at all, because my kids don't want to be famous on TV. They want to be famous on YouTube, and they watch all these YouTube influencers. I don't know if it's your experience, but during the footy season, Samuel loves to watch the ones where they're opening the footy cards, and they open the cards, and it become I think I'm stuck in the 70s sometimes, and Andrea keeps reminding me that things have changed, right? But like, for me, buying a footy card for a pack, for the exhilaration of putting it onto a video so that you can put it up on YouTube for someone else to watch, to me, defeat that. I feel like that is an early sign of spending at the expense of joy. Because I say to them, how many of those cards did you act? Oh, one. I'm like, okay, so you spent a heap of your pocket money trying to get these cards. You got one card. It gave you about 20 seconds of adrenaline hit, and then all of a sudden it's lost. And I think that YouTube doesn't help us, Ben. I'm
It
having this
doesn't.
conversation
That's
with
our
my
job.
wife
Our
as
job
we speak.
our job as parents and our job as educators, our kids aren't allowed to watch YouTube. Right? In terms of the only time we'll watch YouTube is as a family, or we're watching sporting moments or those type of things. But they are not allowed to watch YouTube and go down that rabbit warren into, you can spend hours flicking and going through shorts and all of that type of stuff. And sure, some of them are interesting, right? I'm not immune to the idea that you could spend 30 minutes. But I'm hearing people spending an hour or two on these sort of shorts or TikTok or whatever. I've got more important things in life to live. I don't want to live vicariously through these images of other people. I actually want to do. I want to create. I want to make an impact. And that's not doing that by watching other people do that. So I don't get it. But again, I suppose maybe I am different in a lot of respects.
Well, I think that's the point, isn't it? Because I spoke to one of Jack's friends, my eldest. I said, "What do you do when you first wake up?" Just to try and because you're trying to get a bit of a sense of what the other families are doing, and it's hard to navigate because
Yeah.
your kids are interacting in a way with their peers in the playground, which is different to the way that you and I used to integrate, Ben. So. Like you, I don't let them go down the shorts merry-go-round. I don't let them, if they don't have a purpose, they go and watch the NBA or someone. But I'll let them have 15, 20 minutes where they can explore and do their thing. But if I don't, we become the parent
Well,
that is
I'm the parent who doesn't have a phone for their kids.
yeah.
So everyone, all of the other kids in grade 6 and all that, have got phones for their kids, and I'm like, no,
No, I'm
you
hanging
don't
on
need
to
a
that
phone.
one. Yeah,
No. So, but when they go to high school and they've got buses that they have to catch and sporting
yeah,
commitments, Jack now has a phone, but we waited, and it's like, I don't think they're going to miss out. The biggest problem with the kids getting everything today, they have no sense of waiting and
I agree.
anticipation. And the anticipation is the greatness
I
of, you
100%
lose that
agree.
anticipation. As you say, your dopamine hit is in the seconds, as opposed to the dopamine hit in the hours of saying, I had to wait for that. I had to work hard for that. I had to enjoy that. And, all the people we get on the pod, I did a paper round, I did this, I did that. All of these
Yeah,
people who have lived, experienced lives and are passing on that wisdom. And I see all of these parents who are giving their kids stuff because they asked for it. It's a big question mark for me.
yeah. There you go, folks. So we went off on a tangent then.
We
There's
did
probably a whole bunch of parents
unanticipated tangent there.
that we probably
That
did.
was a bit of therapy for you and I suspect.
It was clearly for you and I because it's a conversation I'm having with my wife right now because
Oh,
I'm like you, mate. I don't want my son to have a phone to go to school and then Andrew goes, well, he's going to be the social leper, and I'm like, okay, let's navigate that because I just remember as I drove him to school, I went past the bus stop and every single kid that was about to get on the bus to go to the high school was looking down at their phone. So how do we? Anyway, I'm tangenting. Clearly, we're not a parenting podcast, so let's move on. But there you go, folks. Entrapped by spending, rather than using money to build a life, life is built around money. Have a think about that as you go into the weekend. Wait till I circle back in the life hack. I'm going to double down on that a bit more. But Ben, today our topic is the final chapter of our MythBuster series. So what we set ourselves the task here is that we have a bunch of teams that are at the coalface talking to clients about how they can help them with lifestyle by design, financial peace, total financial transformation. So we've gone to the coalface and we said, what are the myths that you're experiencing so that we can cover them today? So we've gone to our tax team and to our financial planning team and asked them the questions. So here's the myths that we want to cover today. We'll start with the tax team, Ben. And the first one is this is probably a little close to my heart too, Ben, because it may not be as well known on this podcast that I'm a degree qualified accountant. So I studied accounting.
that
At Murdoch.
explains it, mate. That explains a lot.
Exactly, mate. Go on, line up. I studied accounting at Murdoch University in Perth, Western Australia, Ben. I live just around the corner from the university, but I studied a topic that I'll be honest, I didn't love it, but I was trying to become an electrical engineer, and I didn't get the TEE score. The TEE stands for Tertiary Entrance Examination score. In short, I stuffed around way too much in Year 12 to get the score I needed. So then I just defaulted to going to uni on whatever I could get. I got a commerce degree. I'm very grateful that I did that, but accounting really wasn't my passion. But I worked for an accounting firm in West Perth, Ben, doing tax returns. So here's a question that's close to my heart. All accountants know how to maximise your tax refund on your investment property. That's the myth that we want to either say is true or false. And we're gonna state the argument that that is actually a myth and it is false. And there's some reasons. Now, if you're an accountant, you listen to this, please don't push pause. We're going to come up with some reasons why. We're going to be very respectful to all accountants in the industry, but we're of the view that not all accountants know how to maximise your tax refund on your investment property. And why is that, Ben?
Well, I think that the most common thing, Bryce, is if you look at a structure of an accounting practice, usually the compliance work for mum and dad investors is the work that they pass on to the junior accountants and the beginning accountants. Whereas we don't see it that way in the perfect world. Like in a perfect world, you want your specialist to be absolutely their knowledge source to be quite great in terms of their content and what they understand about the subject matter knowledge that they've got. So our accountants, as an example, that's what they specialize in, right? So we don't do business tax returns. We don't do business strategy and planning for, which is where you get the higher professional fees and so forth. What we do is we focus in on our specialists being looking after mum and dad investors. And that's all they do. And so with that, and it comes back to more broadly, is your accountancy firm that you're working with specializing in what's important for you? So if you're a PAYG taxpayer and you've got one or two investment properties, going to a big firm where the lowest junior tax accountant is going to do your compliance work, is that best bang for buck for you? Because that's the question here. And that's the myth that we're trying to bust. It's the same sort of thing. If you use a mortgage broker, you want that mortgage broker to be absolutely elite at least 10, 15, 20 lenders, knowing all their credit policy. The same applies for your tax accountant if they're going to be doing your individual returns. What we don't want to see is generalist advice or no advice at all, or missing some of the important deductions that are available for you. So if they're laser focused on a particular area, such as property investing, you should get an elite subject matter expert in that particular area, and they become your trusted advisor, and they start thinking about your property journey, not just in the compliance work that they do on an annualized basis, but in terms of, all right, what's next? What are we thinking about there? Have we got our banking structure set up correctly? Are we using the advantages of the offset account like we've talked about before? All of those things, because they're laser focused in on their specialization.
Yeah, so here's what we can say about accountants. All of them would generally be familiar with property and property investing. All of them would generally understand the process of negative gearing and what's deductible and what's a deductible expense and what's a capital expense. So generally speaking, they'd be very familiar, but not all of them are specialists for the reason that Ben talked about before. So here's the deal, Ben. I'm a graduate accountant. I land in the office in West Perth there, and I get a blue file because there are blue files in our office, and I had to do the tax return for the client. Now, 4 years at uni, just stepped into my first job. And so what happens is there was one of my mates, he'd been in the job for about 12, 18 months longer than me. So I would open the file and he would give me a rough guide of what to do. And then I would pass it over to the senior tax accountant that was 3 or 4 years, just done their PY, just into qualification. They would review all of my work, and then they would take the file into the partner, and the partner would then finally sign off on the work, which is fine, standard accounting practice. We all had to account for our 6 minutes. There you go. But the thing is that because I had actually started a property business at the same time, I was becoming a specialist in property, the deductions and the quantity surveys report, which was pretty new back then, Ben. So if you think about when I was sitting in West Perth in the chartered accounting firm, this was 1998, mate. It was a little while ago. So I was interested and I wanted to specialise. So what I ended up doing is I'd walk into the partner and I'd say, listen, I really want to do all of the tax returns for anyone who's got property investment. Give them to me, because it was an area that I was fascinated and totally interested in. So I guess the part of that is I was, and this is full respect to all of those people who were mentoring me at the time, they weren't specialists in property. I could tell you from the inside that they weren't. They weren't investing in property. They weren't specialists in property. They weren't as interested in property as I was. So I was bringing all these outside ideas and knowledge and asking questions, right? But basically what I needed to do, Ben, is I needed to pull out all of the working papers from last year. I'd run through them. I'd go and work out the tax return from last year. And then I'd actually just go and lodge it. And then I'd just go through all the paperwork that they'd sent me. Not that I'd asked them to send me, that they'd sent me, to see if there's anything different. If not, go through the process, fill in the work, pretty much follow what I did last year, lodge the tax return, send it off to the senior partner, away we go. So there wasn't a lot of, did you remember to do this? Did you remember to do this? First of all, because I didn't really know outside of all the learnings that I was trying to do outside what I needed to add. But two, there was no one else. There wasn't a checklist to say, they're a property investor, so therefore have they considered this? Have they considered this? Have they considered this? So that was just a lived experience from me. Again, I am fully respectful to the mentors that mentored me in the past and the role that accountants play. But the reality is the Tax Act is thick, Ben. There's two. Well, when I did, it was 2 volumes. I
think it's 4 volumes now. I think it's up to 4 volumes.
There you go, 4 volumes. And so to be able to go through a particular section of the Act and then be a specialist on that particular part would take a lot of work, takes a lot of years, takes a lot of time to get there. So I guess it makes sense that if you want to maximize your tax refund on cryptocurrency, Ben, you probably should go to an accountant who has an interest in cryptocurrency, has experience in cryptocurrency, and knows people who are doing it and they've gone and done it. If you want to maximize your refund on art, you want to maximize on shares, you want to, whatever it is that's your flavor, you should go to someone who's actually spent a bit of time becoming a specialist in an area. So we think that if you are a property investor, you should do the same as well.
Australian tax legislation, Bryce, 2023, volumes 1 to 4. There you go. So it's complex, people, and that's okay. So if you want to go and get a quick tax return done by just providing your information, and all effectively they're doing is inputting onto a form and charging you $169 or $199 for that process, you're missing the opportunity to actually work with a specialist who's going to be able to add value to the conversation rather than just basically being a bookkeeper for you.
Now, Ben, you had a comment that we were chatting about earlier this morning about what I want versus what I get.
Yeah, that's right. So again, what I want out of a tax accountant is I want a considered conversation. I want them to be asking me more broader questions about activities that I'm trying to, we talk about planning to become what you plan to become. Share those plans with your tax accountant. Because again, even if you've got a financial planner, mortgage broker, property investment advisor, it's great to have that additional information that's shared to your tax accountant, because you want your circle of trusted advisors all to be on the same page. And as you start building wealth, there is opportunities. There are things like different structures. There's obviously opportunities to look at self-managed super funds and all of these other aspects. So you want to be able to get your trusted advisor to share those opinions with you. And my experience when I was young was very much a processing compliance job. And obviously the profession is great and they have a lot of answers once you ask them the questions, but I want them asking more questions of me. And if you've got a great accountant, you know it, because they're asking more questions of you and trying to get an understanding of what you're trying to achieve, and then aligning that piece of work and forward pacing some of those pieces of advice as part of that story, Bryce.
So there you go, folks. If you're an accountant, you're listening to this and we've offended you, our intention is not to do that. Our intention is actually to back you up by saying there is a lot that you need to cover to just be across the depth of the Tax Act. So therefore, unless you are choosing to specialize in a particular area, it is actually unreasonable for people to expect you to be able to dive into the minutiae and the detail of it. So hopefully the heart of the message is coming across there if you're currently an accountant. So there you go, folks. All accountants know how to maximize your tax refund on your investment property. We say that is a myth, because unless they specialize, that's not the case. Number two, I'll just devote a weekend to sorting the paperwork come tax time, Ben. How many people do that? It's like, oh yeah, I'll just deal with that just before the deadline. I'll just get it done. Is that an effective strategy, Ben?
Well, it's not an effective strategy because you're prone to obviously miss opportunities for deductibility. You're not setting up a routine for success as part of that particular story. Now, and if you're running a paper arrangement, you've got to move into the 21st century. There's really no reason why you should have paper receipts anymore. You can check out. Every phone has a note section on there where you can scan a doc, turn it into a PDF, send it to yourself, or send it to your email address that has your tax file information in there. And obviously, platforms like More and so forth through our advisory business, we can store documents in there as well. So there's lots of different ways in which you can do that. But that's what the myth we're trying to bust, and that is that if you do such a thing, you're always scrambling. There's no efficiency in terms of how you're running your investments. And I would be saying is that if you're only looking at them at the end of the year, how's your investment performing? Have you got it fine tuned? Because if again you're just sort of saying, well, look, I've got money in offset, everything's okay. I want to know the performance of those properties. I want to make sure that I'm getting the best that I can out of each property. And so when I do say 6-month reviews, I'm going to be able to do that. And of course, I'll put my hand up here, Bryce. If I've got a money smart system built into More, I should always remind people of that I would set those up as provisional spends. Okay, so I can then simply, in my 10 minutes a month, when I check in and do my monthly checkup on my money smarts to make sure that I'm trapping all of that surplus cash, I just simply go, oh, look, here's an expense that I have against that property, and I put it down as property expense, and I mark it down, and so I know I can basically set it up that way. On the mobile app, you've got the cards, so I have my different property addresses, and then I can record those as part of that. And then so I'm doing it on the go. There's no need to go back and have that efficient or inefficient method of organising my affairs. You can be far more efficient. So when it comes to tax time, you're in a great position.
Oh, mate, you should have been on Life Hack today with that little
Yeah,
provision hack.
a little hack.
Hey, folks, I've been talking to Ben a lot. I think that if you talk to any property investors across this country, even the most sophisticated property investors, they're still doing it via Excel. There is no solution out there. So help me out, folks. Go and hit Ben up on socials. Get his handle at @BenKingsley_AU. Is it underscore or just AU?
I think it's underscore. That's it.
At Ben Kingsley, and just say, Ben, give us the property management option in More ASAP, because that's what I'm hitting him up for. And in his defence, he knows that's coming. But I reckon that's a game changer, because most people don't do a lot of insights into their properties, Ben, because of this myth here. I'll just devote a weekend to sorting out the paperwork come tax time. It's not until the end of the year when they're in a bit of a rush, whereas you need to be getting the input in during the year so that you can actually analyse and think about the insights that you're getting through the year so that you can make some changes. So leave gathering late means you've got no time to, sometimes no space to book in a time. Your documents are a mess. The lead time is actually long, and you can miss little details along the way. So from last minute scrambling, because you might have got a repairs and maintenance receipt that was given to you by a tradesperson who came in and did it, and it was an electronic version, Ben. Or you might have actually claimed an expense that's a depreciable item, and you haven't got the paperwork sorted, and you're scrambling towards the end and trying to remember what was that for. So being digital and getting it sorted, but just leaving it till the end of the year and devoting, that's not a good strategy at all.
And Bryce, just to add further, obviously a lot of the modelling that we do, if you're proficient in your property investment journey, you know that you can actually claim future deductions as part of your pay. And so if you, again, want to be really proficient in having money in offset, you can actually forward advise the ATO about that future loss, and they will adjust through your pay so you get that money on top of that. So this is another example of where money is being lost in terms of people not actually being efficient in that particular story. Now, talk to your accountant, because you can't overstate what that loss might be. But certainly where we are today in terms of a lot more negatively geared properties because of interest rate changes, that is another perfect example, in addition to lazy paperwork, in terms of having a chat about setting up that particular opportunity to have more cash flow coming into the household, rather than getting a big refund check at the end of the year, when that money could have been saving interest in your offset.
That is a perfect example of the first myth that we just busted, Ben, around. Back in my day, it was the 221D form, what you just described. It's now the 1515 tax withholding variation form. But all it's saying is, I'm getting a refund at the end of the year. I don't want to wait till the end of the year. I'd actually like you just to pay it in the frequency of my pay, whether that's weekly, fortnightly, or monthly. If you're not, that was something that I only found out through specializing in the investment circles that I was in, right? But as you say, it's a powerful cash flow management tool for the majority of people, particularly on pay as you go, where everything is predictable and consistent, and the amount of tax that comes out, and you are unlikely to have too much of a variation around what the end result's going to be at the end of the year. So very good point you make there, Ben. So number 2, I'll just devote a weekend to sorting the paperwork come tax time. That is a myth, folks. Don't do that. Get it up to date. Keep it as regular as you can throughout the year. That will help you not only be organised, but it'll give you insights. The third one, Ben, is it's not worth pursuing depreciation since the changes on the 1st of July 2017. So if we forget what happened, the Morrison government at the time was under pressure for housing affordability. They were under pressure with the negative gearing reforms. And all of a sudden they decided, well, let's just ignore negative gearing reforms. Let's just hit depreciation. Let's just hit travel expenses. Let's just hit a couple of these things that are on the side to see if we can get a few political points here. But Ben, is it a waste of time getting a depreciation schedule since the 1st of July 2017? Is this true?
Yeah, Bryce, we don't have to labour on this one because we've mentioned it quite a lot throughout the course of the last few years as well. But the simple answer is, the reason why we're reminding people is there's still people out there who think, well, you can't claim depreciation anymore. And that's not the case. You can absolutely claim depreciation on the building, the write-downs of the building over 40-year period at 2.5%. So ultimately, there's value in the age of the building. What you can't obviously claim is any of the depreciation on the existing plant and equipment, unless you install it. So all our message here is really simple. There are calculators that can guide you through the probability of getting a refund. It is ultimately about getting cash flow back into your offset account. So that's why we say it's worthy of doing. And any reputable quantity surveyor and depreciation schedule provider should be offering you the opportunity to say, if it costs more, for the cost is more than the return that I get in the first year, they'll do it for free. And then, so ultimately, there's really low risk for you to actually do it. And then you get the benefits over the subsequent years. That's going to effectively, again, roll back into your offset account if you do such a thing. So really important. We recommend BMT, tax depreciation guys. They're very thorough. Again, specialists in what they do. They don't do anything else. They specialise in depreciation. So they are also someone would say, give a shout out to them. We earn no money for that. There's no kickbacks, no soft dollars, no commissions, no referral fees. None of that sort of stuff exists. We've never operated that way and we never will. It's a professional recommendation to get that tax return. Scratch the itch, people. And also remember that you can go back 2 years. So if you get a depreciation schedule, you can also have a little bit of a windfall on the previous 2 years as well, is my understanding of the current legislation.
So, folks, we'll put in the show description the link to the form that Ben's just talking to you about. You get a discount. So there's no kickbacks that come to us. You actually get that in the form of a discount. So there you go, folks. There's 3 common myths that we wanted to break from our tax accounting team. All accountants know how to maximise your tax refund on your investment property. I'll just devote a weekend to sorting the paperwork come tax time. and it's not worth pursuing depreciation since the changes in 1st of July 2017. So hopefully that's helped. So just to close that out, Ben, here's what we think a great accountant looks like. First of all, 4 pillars. First pillar is expertise. Just read that as deductions, maximising the deductions that you can get because of they know. Second pillar is advice. So think about structure and future planning, future wealth planning. What name should I buy it in? What's the goal here? So that's the second pillar. Third pillar is actually the planning. So read that as the tax minimisation that you're doing over the journey. And number 4 is compliance. Accurate, on time, audit proof to make sure that you comply. So they're really your 4 pillars that you're looking for when you are looking for an accountant.
Yeah, and I also don't be seduced by a friend of you who told you, "Oh, my account's great. He just lets me claim everything, right? I get this extra," and so that's their way of obviously increasing their volume of business. But the reality is that ultimately you can only claim what's you're legally entitled to claim. So people don't be seduced by your mates. Oh, you just put anything down and you'll let you claim it. They will be found out, data matching. And a little reminder also that the ATO has given clear instructions recently about data matching with the banks. So they are going to be getting all of your information in regards to your lending history with the bank. And so if you've got redraw and you've used that for deductibility and non-deductibility, they're going to do a data match on you. So now more than ever, it's a reminder, now more than ever, you cannot try things on. If you are, you're going to get caught by the ATO. So if you've had money, put it in redraw and then release that money for private use against the investment property, release that equity, it is non-deductible. If you are trying to deduct that money, you are going to get found out based on this data matching setup that's going to occur between all the banks and the ATO. So you'd expect to get an audit from the ATO at some point in the future. So that's also a reminder to all of our fellow property investors to do the right thing. And again, don't listen to your mate down the pub who's telling you, I've got a great accountant, he lets me claim extras and overs, because they're going to get better and better at detection. And you don't want to fine and you don't want interest on the money that you owe the tax office as well. So do the right thing, people.
It's a good point, Ben. Minimisation's okay. Evasion gets you a 3 meals a day, a little bit of exercise for an hour. You will end up being locked away. So there you go. Hey, okay. So we talked to our financial planning team, Ben, and we asked what their myths were.
Yes.
First one is the defence strategy is discretionary rather than a need. So the defence strategy for us is the ABCD. Part of the defence strategy is protecting the biggest asset you have in accumulation phase is your income, right? If you cannot earn your income, this comes crashing down pretty quickly because it's servicing the income. As we've talked about a lot on this podcast, that property investors are not fat cats along the way through. It's not until they reach the retirement phase of the building journey that they actually get to enjoy the spoils. Early days, they need that income. They need to be able to claim against the tax that they're paying when they're earning their income. So the defence strategy is discretionary rather than a need, Ben.
This is a big one, Bryce, because when households start to feel the pinch in their family budgets, the two things that they see that are quite expensive is usually income protection, life cover, trauma, TPD type covers. The second one is obviously the health insurance as well, so their private health insurance. And the reality is that these are assets, people. So whilst you are in your accumulation phase, where you are the biggest income earner as part of that accumulation, these are assets that should be non-negotiable. Like if you're going to pay for car insurance and house insurance, you're actually worth more than your house, given the earnings that you're going to have over a lifetime. So they should be non-negotiable, which is what we're trying to stress here, rather than a discretionary option. Now, how do you then massage them? So as you build out a significant wealth position over 10, 20, 30 years, you can start to shave them back, because ultimately you might have a portfolio of several $1 million worth of property. You've obviously got strong passive income coming off those properties. So in the event that you were hurt at work or that you had a diagnosis of cancer and so forth, you do have a wealth base in which you can tap into. Because the idea of these insurance policies is that wealth base that you need to protect yourself for. So they should work in tandem and adjust accordingly as part of that particular story. But please don't just cut them if you feel like, the budget's being stretched. It should be a last resort type move. The other thing you need to be talking to your financial planner about is some of these policies can actually be paid for by your superannuation policy as well. Now, there are nuances and rules in there that you need to be clear of. So please step through that nuance with your financial planner because if the super fund's paying for it, does that mean if something was to happen, does the super fund get the money or do you get the money personally? Those are serious nuances and you need to understand. And a lot of people also make that mistake in regards to thinking that they've got protections and policies as part of super, whereas in reality, those policies may not be as strong a policy as you need, especially when you've got a debt and also a family that you're supporting. So insurance, protecting you and your loved one and your wife or husband or partner is really essential whilst you're carrying debt and then you have family. If you're an independent person and you own the home and investment property by yourself, and something that's happened to you, it's not as bad. You lose the property, yep, that's true, but it's not as critical. But when you start to form a family formation, it really is quite important to be thinking about that.
So in summary, Ben, you covered that really well. So in summary, if you see it as an expense, we'd like to change your paradigm and twist that to see it as an asset. Because it is, when you need it, let's hope it's an asset that you never need, but when you need it, it is the biggest relief. And we can tell you anecdote after anecdote after anecdote.
Amazing stories of people
Ben shared personally in his own family how that's affected him in previous podcasts. So shift the expense mindset to it being an asset, number one. And number two is when you think about for the people that have been through this, Ben, you and I have been through this, we've got it in our own worlds. You have to go through a bunch of tests and they're onerous and exhaustive because what the insurance companies are trying to do is they're trying to assess you as an insurable risk, right? So if you've gone and done that and you've held it for the last 5 years and all of a sudden we're experiencing some pressure to cut what's perceived as discretionary expenses, we're saying that's a myth. It's actually a need. But what's being perceived as discretionary expenses, let's say you do that and then you might revisit it in the future when interest rates come down and all those sorts of things. Well, you're going to revisit those tests and your health might be in a different set of circumstances to the previous ones when you went through those tests too, Ben.
And your premium price will spike because your age gets older. So if you can hold a premium pathway over a longer period of time as opposed to being a new arrival in your 50s, your premium's going to be a monster.
Yeah. So folks, change the paradigm from expense to asset. That's important. And just remember, if you've been through the experience, you don't want to have to do that too many times in your life. Ben, once, maybe twice is enough, but you don't want to do that 3 or 4 times. So there we go. So that's myth number one. Defense strategy is discretionary rather than a need. No, we think that's a myth. We think that defense strategy is a need rather than discretionary. Number two, financial planning advice is only for middle-aged people. Is that true, Ben? We're middle-aged.
Well, look, the evidence suggests really clearly that if you have long-term financial advice, you're going to actually be in a better financial position over the medium to longer term. So a lot of people are desperate for good advice around cash flow, and I wish more financial planners would do more cash flow modelling as part of their services. But it really is silly to think that you wouldn't get any value out of sitting down and starting to plan to become what you plan to become in your mid to late 20s or early 30s because you do have super. I mean, the amount of people that we see in the platform, Bryce, who have super in more, I'm talking about here, and they've got a balanced investment portfolio as opposed to potentially partial growth or something like that. Now, I can't give advice, but it's just crazy to think that people are missing out on opportunities of building their wealth through super making sure that their super policy is a robust policy, even if they're with an industry fund as opposed to a retail fund, those types of things. It's just about hygiene, getting good financial hygiene in order. The problem with the financial planning business industry, I should say, it is broken. It's ridiculous the amount of compliance work that needs to be done. And that's why the costs always come up as a prohibitive reason why people won't go and get some financial advice and receive a statement advice. I wish they would start again with the whole system because every household needs money advice. They need financial investment advice. That's why, the first 20 episodes of the pod was talking about people doing dumb things with money and trying to change that behavior, because every household earns a significant amount of money over the 40 years that they usually work. And it's about what you do with that money. And so if you're getting smart advice early and you're informed in that decision making, you can transform your life. And the power of compound on those last 10 years is massive if you can start building a nest egg earlier. So I'm a big believer that financial advice in your mid to late 20s is a perfect starting point as life gets a little bit more serious for you.
Yeah, because some younger investors feel that there's less value and only consider it when they get older. So hence where the myth's coming from.
Yeah.
Here's the message to if you're in your 20s or your 30s, right? Here's my message to you. Hopefully on this podcast, we've portrayed to you that the hardest thing for people to do to get a success in any form of investing is to take action, right? So imagine if you're young and you can actually get like a limited statement of advice, Ben, for example, that minimizes the cost and just helps you with the next step in your journey rather than having to sort of get too, planning on your whole of life. Imagine if you developed action pretty early. You then develop the habit that comes from taking the action pretty early, and therefore you understand the nuances of compounding because you started early, even if it's small at first. In these early parts, if habit and action and compounding are the important parts, if you can develop those three things pretty early, that's pretty good. So I've got this theory that 20s are for learning and 30s are for earning, and so. So if you've got access to a financial planner that's helping you with some rigor and some discipline around your money, and then you double down on what is the biggest part of being young is to really try and maximize out your income. So chase networks and exposure is my advice here, because don't chase the biggest pay packet early. Because if you can get in touch with people who have got bigger networks and people who are exposed to different things and you can take those on, you can transfer that into income, which will have a powerful wealth building impact. So setting up early, getting things in place so that you are actually on the track early, whilst spending as much money as you can on your earning capacity, learning the skills, getting the networks, and getting the exposure, I think is the best thing you can do. And clearly, if you can have a financial planner that encourages you to get into real estate or your own home as quickly as practically possible for you, so that you can spend those early parts enjoying the compounding growth that comes from having such a control of such a large asset that allows you to leverage into other things down the track, which includes potentially being in the share market down the track, because that has the capacity to deliver you more income at less leverage levels. Well, then these are all the things that are really important for you to be exposed to. So super is something that you should be interested in your 20s. Having advice is something that you should be interested in having in your 20s and 30s, because they develop the important traits, character traits in you, so that you can combine the traits, the habits, and the skills together. It gets you an outperform result. So therefore, we do not think that financial planning advice is only for middle-aged people. And Ben, yes, we have a financial planning business. So yes, I can hear people going, okay, well, there's a vested interest here, right? Well, don't use our financial planning business. Go and talk to someone else you trust, right? But the point is that there is value in the process of getting someone to actually make sure that they lay some track that you follow that will give you value over time.
We are advocating for financial planning as a professional service. Yep, to Bryce's point, we have our own business, but that's not the point. Bryce, what continues to surprise me and unfortunately disappoint me is the number of people who have multiple super accounts. and haven't even consolidated their super accounts by their early 30s. They've got 2 or 3 or 4 from the different part-time jobs through uni and all that, and they are just their money is getting eaten away in fees, unnecessary fees. So even just going to see a general financial planner and asking him to consolidate all of those into the best of the funds that you might have running is in itself going to save you money and help you make that money earn more money for you. So that's one. The other thing, the governments have to put ads on TV for unclaimed super. So there's money that's sitting there that might be yours that you can quickly check to actually put some more money into your super account. So please, super is a forced saving scheme, but it's going to be very valuable as part of your overall long-term wealth accumulation strategy. So even if you're thinking of other parts why you need a financial planner, the super story is the starting point in addition to the insurances protecting you, because in your early stages, to Bryce's point, in your 30s is your decade of earnings, you need to start protecting yourself, right? You need to start protecting yourself and your family, your loved ones. And if you've got investments like assets like property or whatever, that's when it matters. Because if something was to happen to you and you don't want to lose your house, and certainly, if you've got a partner and they can't support the whole family, you turn to a world of hurt in terms of that. So I think it's really important to understand that. So for me, it's really clear about why you go and see a financial planner. Goal setting. Make sure you get some ideas. I mean, it's the same reason why you go and see a property investment advisor. If you want to do property versus shares or manage funds, set the goals, get educated. You've got an accountability and trusted partner as part of that. Mitigate risk, and you bring that all together in a trusted advisor environment. And you're going to make better decisions through their knowledge and skill, in addition to hopefully hitting more of your planned goals, personal and financial goals throughout the journey. Pretty simple.
Well said. Well said. A mandated Ulysses contract, Ben. Remember, it's a mandated Ulysses contract. I got it right there. So super. So here's one of the key benefits for anyone who's young. If you can understand the concept that super is not an investment, it's not something that you invest in. Super is a vehicle, and it happens to be one of the best tax environments that exists, bar none, in this country for you to actually invest in. The only downside for young people is you cannot touch it because it is a mandated Ulysses contract for you for the future. And that's on purpose, right? But understand that it is an investment. People go, super's not going performing. No, super's going super well. The actual investment vehicle is a very good tax environment, although it's had a couple of little tickles on the side of late, Ben. But it will always, in the future, it will always be better than in your own name because they need to give you an incentive to actually use it. So despite the changes that have been done over the last 3 months, it will still always be an incentive outside of your own name. So
yeah, if you've got 3 million in super, you're doing all right, aren't you? Right.
It's a vehicle. It's not an asset. It's a vehicle. It's not an investment. You invest in it.
Yeah.
So 20s or 30s, you need to understand that. So there you go. So Ben, we think it's a myth that financial planning is only for middle-aged people and older. It actually should be something that probably late 20s and early 30s should consider as well. So, all right, the final one we're going to tackle today is a myth that financial planners only recommend you buy shares. Is that true, Ben?
Well, the history says, Bryce, that if and this is probably why financial planners have had trust issues in the general public in terms of what they were doing. So, if we think about the history of the financial planning industry, it stemmed originally from the accounting world, where accountants moved across and started to do insurance policies. AMP, one of the biggest. They would do door knocking, door to door, basically setting up certain types of investment policies that you contribute to on a weekly, monthly, yearly basis. And there was also education funds and all of these types of things. So that was the door to door salesman aspect, which is never great. And if we think about some of those policies, and I remember my dad signed me up to one of those AMP policies that matured at 18, and then we saw all the fees coming out of it, and we saw exactly how much I'd have at 18. It wasn't necessarily the best investment. We saw the amount of commissions that were being paid to those particular providers. So if you think about it, the origin story is commissions driven industry, when it's all about trying to do the best interest of you as a client, right? So if they're not doing your best interests, it's always going to be a danger. So we've now moved to a fee for service. We don't have as many of those kickbacks and sort of investment funds are doing overrides and those types of things to financial planners to woo them into their schemes and investment vehicles as well. So it really has been, I suppose, reset and professionalized. There's a lot of compliance attached to that. So that's why, unfortunately, it's expensive. It's too expensive, in my view, for the vast majority of people, even though it really is an amazing investment. But that's the backstory. So we've got this problem with trust. I've said earlier on this podcast several times that I really disappointed in some of the advice that you might get from a financial planner because they've got a vested interest in managing an amount of money for you, which they receive an income for, and that would normally be in managed funds, shares, and the like. But please don't underestimate that that's all that they do for you. Because of this professional journey that they've gone on, again, they should be forming part of your trusted advisor group of people that are looking after you and helping with your custodian of money. And if they're doing a damn good job, you should be seeing your money accumulate over the years and decades to come.
Yeah. So what I found I've got a diploma in financial planning as well, Ben, as my accounting degree. So I've been involved in this industry as well, not as an advisor, just as getting the qualification. So what's interesting about financial planning is I think there's a little perception chink which suggests that financial planning covers all things financial planning, right? But unfortunately, it doesn't, because one of the asset classes that you can invest in happens to be the largest asset class in this country, 3 times the size of superannuation, about 4 times the size of listed equities, is residential property, right? So you think, well, here's a financial vehicle that you can use. If I'm talking to the financial planning industry, surely that would cover it. And the answer is no, because they have what's called an approved product list, an APL, and they're only allowed to advise based on their dealer group what's actually on that APL, and therefore not allowed to give advice around residential real estate unless it's within a real estate trust or a REIT or whatever.
Yep.
Because then it becomes part of the approved product list. So that is why you won't get your financial planners suggesting property. But here's an interesting thing, right? Financial planners do recommend property. Our financial planning team recommends that property forms part of it. They help you within a self-managed super fund buy property. One of my best mates outside of our business has a financial planning practice in Richmond. He charges a fee for service. He asks for help from our buyers agency team to actually buy the assets on behalf of his clients who want to buy investment property. So sees it as an opportunity to actually still get some balance. But yeah, look, their industry is directed towards the share market by nature of the way that it's their licensing requires. But I think the important thing here is that not all financial planners recommend you only buy shares. Lots of them do. We recommend on our side property as the bias, but there are lots of financial planners who do that. Interestingly, a lot of financial planners drive strategy, Ben. In our business, they don't. Our qualified property investment advisors drive the strategy in our business, but typically financial planners, if you go into a financial planning business, the financial planner will drive strategy. They will determine what we're doing, and then the execution and the tactics become an offshoot of that, whereas it's a defense part of ours. But look, some clients, we're getting feedback on the ground that they're feeling a little pessimistic about the property market. They want to delay the purchase of buying a property, or perhaps put the funds elsewhere in the share market or into private equity or term deposits. And these are normal responses to uncertainty, and these are normal things that are going through people's minds. And so it doesn't become a which is better. Should I do property versus shares? It needs to have a zoom out moment where we go, what is it that we're actually aiming for here? What is the pathway that we're going to take to get here? And what are some of the anxieties that you're feeling as to why you would consider, I'm going to abandon buying a property because I feel like I want to put it into share market, and why that gives you more certainty and more comfort? It's more about that rather than, hey, now's not a good time to buy property. I want to put it into another vehicle. So I know you're going to jump in there, but I just remember this, Ben. I saw this quote. I can't remember who it was, so I should be able to comment on who it is, but I can't. But most financial debates are people with different time horizons talking over each other. A day trader having an argument with a long-term property investor, they're just talking over each other with different time horizons, right? So
I think like what you were saying before, in articulating your point about our business, Bryce, the customer decides the vehicle that they want in regards to which investment strategy they take. So if they're interested in residential property, then they're going to have a conversation initially with a property investment advisor and do a property strategy. If they're interested in shares, bonds, cash, equities, managed funds, they're going to have a conversation with a financial planner. That's the sort of approach that we take. I think the word that's often talked about in this space is diversification. And I think that is sensible. We've talked about it before from a property point of view by being a borderless investor. That's how you get that diversification in the property investment space. But we've also talked about how we also have share portfolios, and we have other investments, and we have money in cash and those types of things as well. So you are definitely needing to have a relationship with a financial planner for licensed investment products. So when you want to talk about bonds, you want to talk about equities, you want to talk about managed funds, you want to talk about those types of investments, you can only get personal advice from a financial planner in that particular space. And you're hoping that financial planner is going to say, I'm looking at your situation. I can see we've got enough buffer in cash here sitting in offsets. Here's your money in super. That's good. I can see you've got a couple of investment properties with a bit of debt. So let's see how we can manage that debt down. Am I then looking around and saying, is there an opportunity here for a small managed fund or another way in which I can get some term deposit, which might earn me a higher return than the interest that I've got on my mortgage? All of those are part of the blend. And the recommendation as part of what your statement of advice should read should be understanding your objectives at the start. It should be tailored towards those objectives and the reasoning why. The validations of why they're making those recommendations is all part of the statement of advice and the presentation that they'll deliver to you, because ultimately it's your money and it's your investment, and it always should be fee for service as part of that. The only exception to the rule is on the insurance side. A lot of insurances are subsidised through some of the commissions for personal insurances, so that also should be fully disclosed to you as well, so you can make an informed decision on that story also.
So there you go, Vin. We've covered 3 myths each from both of those two disciplines. So the last 3 there, defense strategy is discretionary rather than a need. We think that's a myth. It should be the other way around. Financial planning advice is only for middle-aged people. No, we think that's a myth. I think there's an opportunity for 20s and 30s as well. And financial planners only recommend you buy shares. That is a myth. There is plenty of financial planners who talk about a balanced approach, which includes residential property. So, mate, we've covered a fair bit. Hopefully that's helped you, particularly as we lead into end of financial year, Ben, at this time of the year. We're definitely in the shadows of the end of the financial year, and also understand some of the pressures that people are experiencing now with tension, Ben, on their budget.
Well, look, money's tight, so we've got to make sure it works for us. So I think it's a timely reminder to say, get help. Trust me, it's not just about a penicillin hit right now. We're talking about a long-term, well thought out approach to how you're going to build wealth over time. And it starts with great money management, to trapping surplus, and then making that money work for you and getting a team of trusted advisors around you.
Well, so thank you, Ben. My life hack today is a continuation of my Mindset Minute theme, which I talked about before. So the Mindset Minute was, are you entrapped by spending? So now is a very good time to be analysing if you are entrapped by spending in your own life, Ben. So Marie Kondo wrote a book, The Life-Changing Magic of Tidying Up. I've spoken about this before, and I thought, why are we talking about this when it comes to being entrapped by spending? Well, in her KonMari method, your feelings are the standard for decision making, right? So specifically knowing what sparks joy. And I'm like, What sparks joy? Didn't we just talk about that with spending? Is it sparking joy or not? So when you're picking up, and she talks about it with clothes, you pick up the clothes, you pick up each object one at a time. You ask yourself quietly, does this spark joy? Pay attention to how your body responds. So I thought, well, how can we combine these two methods? One is a philosophy around being entrapped by spending, and a second is a method of decluttering your home. Well, can we declutter our expenses, Ben? So I've thought about this. I go, what about subscriptions? Are they all being used? Do you have Disney, Netflix, Foxtel, all of them, and which ones bring you joy? I can promise you, Ben, I've got a KO subscription, and it brings me a lot of joy. I love watching football games in the mini version at 28 minutes rather than 3 hours. I love watching NBA games. It brings all of my family lots of joy. But we had a Disney one, so I did a little. Is anyone watching Disney? Nah, we're not watching. Bang, gone. Subscription's gone because it's not. It's just an expense for an expense sake. It wasn't bringing joy. So, do they still give you the same buzz when you signed up? What about eating out? Is that a habit, or is it bringing you joy? Do you love the ritual of a pizza on Friday night with your family, where you go to the restaurant, you eat the pizza, you see the cheesy crust and everything, you go home, you sit down, you watch your family? That's a ritual that you do not want to get rid of. But is it just, it's just easy, I don't actually enjoy the pizza, I could actually get some more joy out of doing it somewhere else? What about at home? Could you get a roommate? Is that possible? Would that be able to help you? What about transport? Can you catch the bus? Can you carpool? Can you do what Ben suggested only a few weeks ago, that if you're driving to the footy, can you turn that into an Uber drive for those common trips? What about utility bills? Can you have shorter showers? Can you turn off the lights? Ben, you and I can talk about, your dad says, what are we living in Luna Park? My dad says, is anyone turning these? So there's three. We always talk about two categories of expenses, Ben: essential and discretionary. Is there three? Is there essential, discretionary, and the ones that bring you joy? So now is the time. So my life hack today is analyze where you are entrapped by spending and stop it. Get rid of it.
Mate, I love it. I absolutely love that. That was awesome. I got a couple of things to also throw in there. It would definitely bring me joy in terms of reducing my rent if I could get a flatmate coming in there. That would bring me a lot of joy. So I really like that one. I do also think that, in terms of Maria Condi telling me that story, I reckon Harry's going to be smart enough in my household to say, Dad, I'm not cleaning up my room because it doesn't bring me joy. And I'm going to say, well, I know what brings me joy. So let's see if we can turn that conversation around. But no, I love it. That was a ripper.
Very good. So try that out, folks. Check it out. If your budget is under attack, try not to get rid of your defense. Try and get rid of some of the stuff that you are entrapped by spending that doesn't bring you any joy. Hey, Ben, what's making property news?
Mate, this is an important update for what's making property news. So thank you for those people who have hung around, because I'm going to try and keep my emotions, I'll try and keep them in check a little bit, right? But we saw at the end of last year, around November of last year, there was a report that was released called Regulation on Residential Tenancy and Impacts on Investment. Now, this report was all about trying to put a case forward. They're saying it's been peer reviewed, but they wanted to put a case forward that there's no evidence, Bryce, that there's no evidence of the reforms that have been going on in other states and territories around the country that's having an impact on demand of residential property. Right when we both know that there's never been a more important time to have an additional amount of residential supply. Now, why am I bringing up this report, Bryce? Well, here's the reason why. We've seen that the Queensland government have announced they've released a reform opinion paper called Stage 2 Rental Law Reform. And so this is me wearing my picker hat because I'm concerned about what I read inside that particular report, Bryce. And let me try and explain it to you. So this reform option paper is now calling for feedback. And so I'm talking to all of our property investment community out there. They want feedback in regards to further changes to Stage 2 rental laws in Queensland. Now, It's being run by the Department of Communities, Housing and Digital Economy. And submissions close at 5 p.m. Monday, the 29th of May. So you've got a couple of weeks, just under a couple of weeks to get yourself.
11 days as of the date of recording, Ben.
That's right. So I thought I wanted to have a look at this because here's my problem, Bryce. I've got a real problem with the fact that the way in which this paper is framed says to me that there is a real issue going on between tenants and landlords, and they're quoting the regulation of residential tenancy and impacts on investments report as part of that. So I'm going to come to that. But here's what's happening, Bryce. We have associations and alike, limited associations such as the Tenancy Queensland, right? Tenants Queensland is a government-funded association. They get around $7.7 million of government money to support tenants in Queensland. Now, I have no problem with that. I mean, ultimately, there are going to be tenant disputes and the like, and those people need support. So I have no problems with them advocating on behalf of tenants. But here's the thing, Bryce. In their annual report in 2022, they had presented issues, 28,637 issues, ranging from termination to bonds not being returned to repairs and maintenance. And so they give us a bit of an idea there in terms of those issues. Now, in addition to that, they also said termination problem, right? This is this whole argument around no cause termination. But interestingly, Bryce, no actual count here, just percentages of the issues that people were having. And also remember, in terms of when this actually goes to the tribunal in Queensland, a lot of those tribunal actions have been brought on by landlords or property owners. So I did some numbers, Bryce, and I just wanted to share this with our community. So based on the last census data, there are 618,442 rental properties in Queensland. And based on what Tenants Queensland are telling us, there were 28,637, let's call them disputes, in terms of what's happening there. Now, Bryce, that represents 4.6%. 4.6% of the market. So here's another example of 95% of the market happily going on through quiet enjoyment, obviously providing quiet enjoyment and safe and secure housing for those tenants. So a lot of the relationships between property owners and tenants are going pretty well, because if we're only getting that number of disputes, but here's our problem. These lobby groups, they're well funded by government, and they're now impacting in terms of trying to get more severe laws introduced. So this brings me back to this research paper. This research paper that was introduced and is quoted inside this review paper that is very concerning for me, right? Because the findings in that research report, it's called Final Report number 391, and we'll put the links in the show descriptions, is their conclusion was, Bryce, that there's been no material impact to the demand from property investors in regards to the regulation changes that have occurred. But we have some fundamental problems with the findings of this report because, interestingly, the two methods in which they made their conclusion, one being an analysis of bond payments and the changes in bond payments for over a 20-year period up until 2020, looking at New South Wales and Victoria bond exchanges. The problem with that, Bryce, is that period of time was way before the Victorian government introduced their 133 legislative changes that were introduced in March 2021. So the research that they conducted was up until Q1 2020. And in addition to that, the reforms in New South Wales, which was the other part of this part of their research, was also changed in March of 2020 with no fault or no reason still being retained in New South Wales. So we've got this big problem of these lobby groups talking about 5% of the market that aren't that aren't getting what they want, and effectively are looking to change the regulation right across the nation. And they're using this report, which is deceptive and misleading on those grounds. But it gets worse, Bryce. There was also an independent report, or survey, I should say, that they did for 970 existing, previous, or budding future property investors. Now, what's interesting in that 970, again, they didn't find any material change when that survey was done in September of 2021. But here's what's interesting in that 970 responses. The bulk of the survey was done with Queensland investors, where they hadn't actually seen stage one of their tenancy reforms introduced. So effectively, if you're going to survey me and I'm only own an investment property in Queensland and there hasn't been stage one introduction, of course I'm going to say, no, I'm still keen to keep buying properties because you haven't seen the reforms that are coming. But now we've seen the reforms that are coming. And so they're using old data to try and prosecute a new argument. And we are seeing anecdotally through articles in newspapers and everywhere that investors have been frustrated and are getting out. But it's even more succinct in regards to the sentiment survey produced last year by the Property Investment Professionals of Australia, which had a really important finding in that particular report. So there was a question in there, reason for selling a property in the last 12 to 24 months. A quarter, that's right, 25.1% stated the changing tenancy legislation making it too hard or costly to manage their properties. That is recent data. And we are going to get reform in Queensland because the irony here is the people who fund the Tenancy Queensland, Bryce, the Department of Communities, Housing and Digital Economy, guess what? They're the major funder of the Tenancy Queensland. So they're conducting the review, but they're also providing the funds for the lobby group that's trying to make those changes. So that smells a little bit in terms of, you're getting your funding. So it does feel like when you're reading this options paper that they've already made their decision, even though you have three options in there, which is the status quo or, further education or introducing new reforms into those areas. Now, make no mistake, we absolutely love the idea. So I'm wearing my picker hat now, that people have quiet and safe enjoyment of a property that they're contracted in a lease arrangement. We absolutely believe that. And make no mistake, there are bad landlords out there, just like there are tenants who are also damaging properties and aren't doing the right thing by their property owners. So we think that there is room for movement in making sure there's safe and quiet enjoyment. And for those most vulnerable members of the community, there also needs to be more social and public housing as part of that. So what am I asking for and why am I sharing this information? Well, I want everyone in the show description. If you're a picker member, you're going to see a newsletter from me or an email coming from me as the chair to absolutely make a lodgement, make your own submission to those reforms, tell your story, all right? Because I get it. If I'm at Tenancy Queensland and I'm listening on the phones to all of those horror stories and the challenges that some tenants are facing, naturally I'm going to feel frustrated and upset for those people. I can feel their frustration. But here is the problem. Not too many property investors, landlords are telling their side of the story and how good they have been and how respectful they have been and what they do in terms of their consideration. We only hear the extremes on both sides. And so my argument here is it's really clear that we're going to bring in reform for 5% of the marketplace. When even if we say it's for 10% of the marketplace, 90% of the marketplace, the market's working. The market dynamics, the free market is working to see people have access to properties. But if you keep taking away the ability for investors to come into the property market through all of these regulatory changes or these radical ideas around charging land tax in other states and territories, you are going to dismiss the future opportunity for that critical supply of rental property when you need it the most. And so I'm calling on people to put their own submission in. And of course, Picker is working on our formal submission, and that will be in by the deadline. So reminder of the deadline, it's the 29th of May at 5 p.m. And we'll put in the show notes of the links to actually have your say. It is really important that you do have your say. And I also encourage you, we'll put a link in the show notes to read that regulation of residential tenancy and impacts on investment report, because I've just debunked it, right? It's really clear that, yes, if we were looking at all of that data back in pre-2020 time, and we're doing a survey before any of this regulation was introduced, and it's definitely changing the mindset and behaviours of investors as documented in the latest PIPA survey. It's really important that that message gets into government, because right now those lobby groups are well funded. They are making sure that they're getting a lot of noise and creating potential law reforms to impact maybe 5 or 10% of the marketplace, and obviously potentially damaging the other 90% of the marketplace that's working. So I'm super concerned about this. This is why Picker is all about having a voice, and it's also why I'm sharing it to the community to make sure that the truth is told, and we're not seeing these smokes and mirrors types of reports, which are effectively looking at old data when reform wasn't in play.
And obviously a bit of thought gone into that. I said before we recorded today, I haven't seen you this fired up since you almost choked on your Wheaties back when Chris Bowen was on breakfast television saying that only 4% of all properties was it established?
He was saying only. I think it was like 93% of investors buy existing, and only 7% buy new, or something like that, which was ridiculous,
right? So you've been fired up today, but clearly there's a call to action, folks, for anyone who believes in property as an asset class generally, because it's happening in Queensland, but it can happen anywhere. Clearly you've well thought that through, mate, because you have debunked a few of the key parts of it. And if there was any question, which is not from me, whether you are representing the interests of investors, clearly
totally.
From the
I'm
passion
advocating on behalf.
Yep, 100%. So there you go, folks. Woo, let's take a deep breath. We've covered a lot today, mate.
Thanks for hanging around.
We've covered the art of spending. We've covered some myths in financial planning. We've covered some myths in the tax planning business. And, of course, you have covered something that you are very, very passionate about with that. So we hope that you get involved with that, folks. Click in the show description. All of the links that you need will be in there so that you can play along at home. Mate, always a pleasure to hang out with you each and every week on the couch here, mate. Until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Well said. See you next week, folks.